This checklist has made me so much money because it really allows me to drill down and figure out what I actually own and why I actually own it. Now, anyway, let's get into the rest of the video. As you can pretty much see, there's different sections in this checklist, what obviously I'll be going over. Now, they're not necessarily in any specific order. They're just in an order what I find very comfortable for me, but obviously you can adjust it to however you actually want. Now, I don't know if I said this before, but you can pretty much get this Excel sheet in the description box down below. Now, if you just use the code Excel, you'll basically get it for absolutely free. So don't worry about it. But anyway, let's get into the first section. What is the management and insider activity? So the first area what I typically look for is the company founder-led? So typically founder-led companies tend to have stronger vision and execution. So a lot of, let's say, very well-run businesses are normally founder-led. It's not necessarily a exact science, but if you look at companies like Nvidia, Amazon, Meta, Berkshire Hathaway, Tesla, Netflix, Salesforce, these are all founder-led businesses. Now, the reason why I think it's massively important is because founders are not necessarily looking at things from a quarter perspective. They're typically looking at things from a longer term perspective and the overall vision for the business. Now, the second point is, do insiders own a significant stake? Now, this is absolutely crucial because, like I was saying to you before, when I was first starting out in investing, I invested in a few different businesses, and I later found out that the management and the board didn't really have much skin in the game in terms of their investments in the business, and it wasn't really aligned with shareholders. Now, the reason, obviously, why I think it's massively important is because you want that alignment from management and shareholders, because that is absolutely critical. Because the thing is, you want the management to be making decisions what are in the best interest of the shareholders, not necessarily in the best interest of themselves, what is obviously getting a very, very, very large salary and bonus. So you want to be making sure that the insiders have a significant stake. Now, the third point is, have insiders recently bought stock? Now, this might seem very obvious, but obviously insiders buying stock is typically a very strong bullish signal. Now, they won't necessarily be buying stock if they weren't really optimistic about the future projections of the overall company. So that typically is a very good indication that there's good things ahead for the business. Now, the fourth point is, have insiders recently sold? And if so, what is the ratio to their holding? Now, the reason why I think this is massively important is if you take some recent news like Nvidia. Now, the Nvidia CEO has recently been selling some chunks of his position. Now, some of these headlines is kind of like, oh, Nvidia CEO has sold 25 million of stock. Now, when you look at let's say the sale of that stock in relation to their overall holdings, you want to be making sure that it's let's say a relatively small percentage rather than a very large chunky percentage. Because like I'm saying, if you've got, let's say, $1 billion in stock and you're only selling, let's say, 25 million, that is, in the grand scheme of things, that is absolutely fine. But obviously, if you've got $1 billion in stock and you're selling, let's say, 600 million, I mean, that is a bit of a red flag. So you want to be taking these sales in relation to their overall holdings, because obviously they might be selling for tax reasons, they might be selling because they want a new house or whatever, like personal reasons or whatever. So again, just make sure that you look at their sales in relation to their overall holdings. Now, the fifth point is, does the CEO/founder have a long-term vision? Because like I was saying to you before, the best CEOs typically think in decades, not necessarily quarters. And the thing is, this is absolutely apparent when you start to look into founder-led businesses. Now, like I was saying to you before, this is not necessarily an exact science, but you want to be making sure that the founder has a very long-term vision for the business, what is obviously going to be very beneficial to its shareholders. Now, the sixth point is, does management have a track record of smart capital allocation? So look for reinvestment in growth areas rather than wasteful buybacks or dilution. So going back to my earlier, let's say, investments, I made an investment in a company what was making, let's say, a lot of acquisitions, and they were putting money to work in different types of jurisdictions in terms of buying facilities. Now, I didn't really think too much of it, but what I found out with this business is that obviously the management didn't really have a significant stake in the business, so they weren't really aligned with shareholders. And what I later found out through a short report is that these acquisitions of these, let's say, distressed assets were kind of sold and bought from their friends. It's very high prices. Now, again, like if I looked through the company's history, I would have seen this throughout the months and years of that actual company, that basically management didn't really have the best interest of the shareholders, and they just kept making these acquisitions what were not necessarily accretive to the overall business. So again, the reason why I've put this here is because you want to be going over these, let's say, acquisitions, or where they're putting money to work, and making sure that it's actually accretive to the business for the long term. So I think it's massively important to make sure that they are putting money to work, what is in the best interest of shareholders. Now, the second section is the financial strength and stability. So does the company generate positive free cash flow? Now, this is not necessarily an exact science, because ultimately, when it comes to growth businesses, they don't really have much cash on hand. But again, the reason why I want to focus on positive free cash flow is because looking at the cash balance can be absolutely critical, especially when it comes to, let's say, financing and paying their obligations, because you don't really want them to have very little cash on hand, because obviously they'll have to go and raise money, and that is going to be detrimental if you are a shareholder. Now, the second point is, does the company have a high return on capital? And typically what you want to be looking for is something with at least a 15% return on capital. Now, this is typically considered very strong, and it normally suggests that the company is generating healthy profits compared to the capital it uses. Now, this typically means that the company has a significant competitive advantage, also known as a moat, and it's also efficient with its resources. And ultimately, it can grow without relying too heavily on debt. Now, this is the reason why you want to be aiming for at least 15%, because these are typically very, very, very well-run businesses. Now, the third point is the debt to cash ratio below the 1? Because excessive debt increases risk, especially in downturns or when the cost of capital goes higher. So now you really want to be assessing these investments from a debt to cash ratio below than 1, because ultimately you don't want to be investing in a company what is significantly indebted, and especially if you start to see interest rates start to obviously creep up, because that is going to be very, very, very detrimental to the business in the long term. Obviously, if rates stay elevated, and obviously if anything happens to their revenues, they'll have to keep servicing that debt. And obviously what pretty much happens is that they go back to the market and obviously raise even more money, and that typically isn't really good if you are a shareholder, because that typically means more dilution. Now, the fourth point is, does it have a strong cash position? Now, cash reserves provide resilience and fuel for acquisitions. Now, I know that I touched on this before, but cash is very, very, very important, because it pretty much allows the business to have oxygen. I mean, it basically works as oxygen. I mean, when you don't really have much oxygen, you're very, very aware of it, right? But obviously, when you have a lot of oxygen, you don't really feel it. You don't really feel breathing or the struggle of breathing. But yeah, just see cash as a very, very good thing. And this is the thing. I mean, a lot of investors see a company what holds a lot of cash as a bad thing, because they think, oh, they're not necessarily investing it as aggressively as I would like them to. But again, I mean, it's all dependent on your risk appetite and obviously your understanding of the business. Fifth point is, does the company require constant debt to grow? So low dependence on debt is ideal, because if they keep issuing more and more debt, and obviously if they keep going to the market and raising more cash through dilution, I mean, this is not really what you want to be looking at, because over the long term, the company might grow, right? But if that growth comes at the expense of shareholders, that isn't really going to be a good investment longer term. So even though the company might grow on the basis that they are obviously issuing more and more debt and obviously diluting their shareholders, that is not going to be really that good. It isn't really going to be that good if you are a shareholder. So now I would typically stay away from businesses what require constant debt to grow. I mean, obviously in growth businesses, depending on their growth rates Well, again, you can kind of get into the weeds of different types of growth rates, right? But you want to be making sure that they are not just issuing more and more debt to obviously sustain their growth, because ultimately, if anything happens in the markets, or let's say capital starts to dry up and they can't sustain that growth, or they can't sustain that revenue to obviously pay off their debt, then they're in a very, very tricky position, especially if they don't have much cash and they're in a shed load of debt, because ultimately that just means, again, like I was saying to you before, more dilution, what obviously is bad for share prices. Now, the 6th point is, are gross margins above 50%? Because high margin businesses typically have very strong pricing power, and this typically means that they have very good products or very good services. Because I mean, if you take it in relation to Coca-Cola, for example, I mean, Coca-Cola is obviously producing a lot of different types of products, and people are very, very loyal to them specific brands. So typically you can see this in consumer products, but also in software as well, like Adobe, for example, or Microsoft or Google. Like their, let's say, Microsoft 365 or Google Suite typically has a very good pricing power, because it's very, very sticky. Once they're in the ecosystem, it's very difficult for them to leave, so their pricing power is very. So the 7th point is, does the company have an improving profit margin trend? And this is important because expanding margins typically indicates increasing efficiency in the business. So if their margins are obviously becoming wider and wider for whatever reason, I mean, that typically would indicate that they are very, very, very good at allocating capital, and most importantly, increasing their prices over time while maintaining their operating expenses. Now, the 8th point, what I think is very important, and that is stock dilution under control? Assess whether the company uses an ATM, what is at the market offering, or other equity financing methods. Excessive dilution can erode shareholder value over time. And this is what I was saying to you before in regards to debt to cash ratios, because, and this is the thing, you don't really want to be getting into a business where they are constantly coming up with different types of financing methods, what typically is very detrimental to shareholders and not really accretive to the actual business, in terms of financing the business through dilution or through at the market offerings. Again, you want to be looking at this through their investor sections on their websites, and just any news or any press, especially when it comes to these ATMs, because like what I was saying to you before, when I was first getting into investing, I heard that there was a lot of companies who were doing these ATMs, and these ATMs, don't get me wrong, they can be very beneficial to shareholders, but I've just found that they typically are not accretive in the short term. And obviously this has a large impact on share price, because they typically issue a lot of shares at the market, what obviously puts a lot of supply on the market, what obviously suppresses the overall share price. So typically I would be very cautious about looking at a company what is constantly using ATMs to grow. Now, the 10th point is, can the company meet short-term and long-term debt obligations? And like I said to you before, this is why it's very, very important to assess the overall cash balance of the business, and obviously assess where the revenues are actually going, because if they have a significant amount of debt and they have all of these different types of, let's say, very quirky financing methods and a lot of these obligations, what they have to pay, this can be, again, very, very, very bad for the business in the long term. Now, the 11th point is basically checking the ratios. This is PE ratio, what is price to earnings, price to book, the EBITDA ratios in relation to peers and historical averages, because you really want to be assessing, are you buying a very overhyped or overvalued company in relation to its peers or historical averages. Now, the 3rd section is growth and scalability. So you want to be kind of assessing, can the stock 3x, 10x or 100x? So look for massive runways for growth. So how will the business grow in the future? Now, one thing what I found that most investors typically make is that they don't really look at, let's say, stock splits, what obviously can massively affect the overall, let's say, share price from a charting perspective, and also as well the amount of shares what are in issuance. Because again, just because the share price is going down doesn't necessarily mean that people are actually selling. It might be that the company is actually tapping into their ATM and that they're issuing more shares on the open market, what obviously is suppressing the actual share price. So you want to be assessing their share price in relation to their number of shares outstanding. Now, this is another thing to actually take into consideration, because the thing is, are they issuing more and more shares every single year, every single quarter? And obviously that will have an impact on the overall share price. Now, the second point is, does the company reinvest profits into high growth areas? Reinvestment is key to compounding returns. Now, I have been a very long-term investor in Bitcoin mining businesses, and typically what you normally see, especially in Bitcoin mining businesses, is that they are mainly just heavily focused on Bitcoin mining, right? Now, some of these companies are reinvesting their profits into high growth areas, what is high performance compute and AI data centers. Now, this is what you typically want to be looking for in terms of diversification from a revenue perspective, but also as well that they're reinvesting into high growth areas, obviously for the future of the business. Now, the third point is the market cap under 10 billion? Now, I normally look for businesses what are around 1 billion to 10 billion, what have a very, very, very large runway for growth. Now, obviously, smaller companies have more room to grow. So typically looking around 1 billion to 10 billion, what obviously has the potential to grow to 100 billion to 200 billion is what I really want to be looking for. Now, obviously you can look for businesses what are, let's say, valued at 100 million and obviously have the potential to go to, let's say, a billion. Now, looking at the market cap, I think is absolutely crucial because it will give you an overall assessment of how large the actual company is and how much room that company has to grow. Now, I was recently sat with a friend of mine, and he was basically saying that he's going to buy Nvidia. It's, let's say, $120 because it's going to go to $300. And I was just explaining to him that obviously for it to go to $300, that means that the market cap of Nvidia basically needs to be around 8 to 9 trillion, what is absolutely huge. Now, to get, let's say, a 3x return or 2x return on your money, it's probably a lot easier to find a company what has the potential to go from, let's say, 10 billion to 30 to 40 billion rather than going from 3 trillion to 9 trillion, because there's a lot it requires a lot more momentum to go from 3 trillion to obviously $9 trillion. Now, the sixth point what I typically look at is, has the earnings per share increased for 8 or more quarters? Now, you want to be looking at consistent earnings growth, what typically signals strong execution. Now, you might be picking another different type of metric outside of earnings per share. You might be looking at the amount of units what have actually been sold. You might be looking at top line revenue. You might be looking at the operations. So again, it's just assessing and looking at different types of metrics what can be signaling to you as an investor that management is exceptionally good at execution. Now, the eighth point is, does it have pricing power? Can it raise its prices without losing customers? Now, a very good example of this is that I was a early investor in a company called Xero. Now, Xero is a piece of accounting software. Now, typically when somebody signs up for a piece of accounting software, they're pretty much locked in. They get used to the software, they get used to obviously managing their entire business through Xero. Now, if they just raise their prices, let's say $2 or $3, you're not really going to lose a lot of customers. You're basically going to keep retaining the same customers because they're not the cost of switching is too high. Like, for them to learn a new piece of software and for them to, let's say, export their data and move it to somewhere else for the sake of a couple of dollars is not really worth the time and energy. So in terms of pricing power, you want to be looking at how sticky is the product, or how sticky is the brand, how sticky is the service, and just assessing, can this company raise its prices without losing any customers? It follows on to the ninth point. What is, are customers locked into the business model? Subscription-based revenue or high switching costs can create stability. And like I was saying to you before with Xero, if they decided to raise their prices by $2 or $3, that will have a large impact on their top line revenue. But majority of their customers are not going to leave, because in terms of switching to a new piece of software, it's going to be the juice ain't worth the squeeze, so they'll just happily pay it. Now, finally, the 10th point is, what specific catalyst, operational change, or from a regulatory perspective could unlock value? So assessing trigger events that might prompt a re-rating by the market. So looking at different types of catalysts, and like just touching on the Bitcoin mining companies again. I mean, obviously with Trump being in office and with his administration being very pro crypto and very pro Bitcoin, typically this would be a great catalyst for any business what is operating in that space. Now, the fourth section is competitive advantage. Now, does the company have a strong brand? Like, brand loyalty leads to pricing power and consistent sales. So you want to be assessing this all the time. So the second point is, does it have a durable competitive advantage? So you want to be looking for, so some examples to be looking for is network effects similar to Visa or Facebook, or cost advantages similar to Amazon and Walmart, or switching costs similar to Microsoft and Adobe, or intangible assets like patents or exclusive deals, because these areas will help the business grow significantly in the future. Now, this leads on to the fourth point, what is obviously who are its competition. A company without competitors may be in a very weak market. So you want to be assessing, are they in a very, let's say, desirable market? Do they have a lot of growth opportunities ahead of them? And does it have a competitive advantage from a network effects perspective, cost advantage, switching costs, or intangible assets? Or you want to be looking at things what give this business a better edge in comparison to its competitors. Now, going back to the whole Bitcoin mining space, like I was saying, I've been in this space for a very, very, very long time, and you can start to look at, let's say, energy procurement contracts in terms of which miners have the best energy agreements in place, because that will obviously give them a better competitive advantage in terms of being able to mine Bitcoin at a very cheaper, desirable price. Okay, so the next section is the valuation. So is it undervalued? So obviously this is more of an art than an exact science, but these are things what I would typically look at. So is the stock trading at a discount to its intrinsic value? So you can use things like discounted cash flow. You can also use something called a dividend discount model, DDM. Now, the reason why you want to be doing this is buying undervalued stocks increase potential returns over time. So the second point is the PE ratio discounted compared to the industry average? So a lower PE relative to peers can indicate an opportunity. Now, also as well, you want to be a little bit careful about PE ratios, because they are pretty much, I would say, relatively irrelevant for very high growth companies. So they are typically used for value-based assessment in terms of evaluating, let's say, very stable businesses. So the fourth point is the company undervalued relative to future growth? So you want to be looking at the PEG ratio, what is below 1, what typically suggests that the stock is cheap for its growth rate. So the fifth point, what I would be looking at is, has the company been punished due to short-term volatility? So has the market overreacted, what has created a great buying opportunity? Now, ultimately, you want to be assessing the negative news and determine if it's a short-term issue or it's a fundamental problem in the longer term. So the next section is red flags and risk management. So you want to be assessing, does the company have a history of shareholder dilution? Because excessive dilution reduces the value of existing shares. And this is what I was talking about in the previous sections. And this is very, very, very important. And this is something what has cost me a hell of a lot of money over the years, because I didn't really pay too much attention to it. So you want to be making sure that management is not using excessive dilution tactics, what ultimately reduce the value of the shares. The second point is, has the company consistently beaten or met earnings expectation? So if they are constantly, let's say, missing earnings, this can be a big warning sign. So you want to be taking this into consideration, especially when it comes to getting a position in a company. Now, the third point is it too reliant on one product or revenue source? So diversified, so looking at diversification in terms of revenue streams can provide stability, especially when it comes to predicting earnings and ultimately revenue. So the fourth point is it at risk of technical? So the fourth point is it at risk of technological disruption? So think about companies like Kodak or Blockbuster, what were destroyed by innovation. So try and think about any technological disruptions, what obviously would have massive implications on their revenue. So just try and write them down and just try and think of the risks. So the next point is just assessing what is the downside risk of getting involved in this company, buying stock in this company. Now, you always want to consider the worst case scenario. So again, you want to be viewing it from a, let's say, a pessimistic lens, and just trying to assess, again, what are the biggest risks to this business. And finally, on the red flags and risk management section, what I think is very, very, very interesting to actually do is look through anything on Twitter or anything on Reddit and just look for any short reports of the company, and obviously what the outcomes of that short report were and when was the short report, because this can really give you some great insight in terms of the underlying problems in the business. Now, short reports are not necessarily written all the time, but when they are written, they do kind of give some good insights in terms of how the business is actually ran and managed. Now, just to be aware, when a short report is obviously published, the company who obviously is doing the short report would obviously have a short position in the business. So, as you can probably imagine, it's going to be a little bit biased in terms of being very negative towards the business. But again, these are very interesting to actually read. So the next section is personal conviction. So what you want to be assessing is, are you being biased around the investment? So you want to remove any emotional attachment to the actual stock. So you really want to be getting, let's say, into the weeds in terms of assessing whether or not you are being very overly emotional around it, or there's actually real conviction and a real thesis about why you should be buying it. Now the second point, what I typically ask myself is, do I understand the business in 60 seconds? And can I explain it in a very simple way? Now, if I can't explain it in a very simple way, I would normally avoid the business altogether, because again, I don't really understand the sector, understand the business, and if I can't explain it in a very simple way, I don't really understand it enough. So I would completely avoid it. Once I've written all of that out, I would then say to myself, do I have a clear thesis for buying the stock? If you can't write a simple thesis, I need to rethink the investment. And most importantly, the last point is, what will make me sell the stock? Define exit criteria before buying to avoid emotional decision making later. So again, I would write down the reasons why I would sell and the reasons why I would buy. And I think it's very, very, very important to write down the reasons why you would sell, because ultimately, when things start to go south, you don't want to be very emotionally attached to the actual stock. You want to be, okay, well, I said that I was going to sell the stock. If management was going to issue a very large ATM, if they was going to dilute shareholders, I'm not going to necessarily buy more. Now, again, you have to assess the overall picture of the business. But again, it's writing down the reasons why you're buying and the reasons why you are selling, or the reasons why you would sell. And finally, the last section is final thoughts. So does the company have a 20 or more years of runway? Now, typically the best compounders take time. Does it reinvest its earnings into high growth opportunities instead of paying large dividends? The third point, does it have a competitive advantage that gets stronger over time? So expanding moats are key, because this really pushes away any competition. Now, the fourth point is it in an industry with massive future potential? Investing in growing industries increase long-term success. And finally, the final point is, am I willing to hold this for the next 10 or more years? Now, again, these are just questions what I ask myself before making any investments, and it really has helped me make a significant amount of money over the years. And like I was saying to you before, it's really made me realize about me getting into investments and taking the emotion out of them investments, because I basically go through this checklist before making investments, and if I can't answer these key questions, then I don't really know why I'm getting into it. And like I was saying to you before, a lot of it is to do with being emotionally charged around getting into these investments, and because your friends are saying it, etc., 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 or you read it on YouTube, or you read it online, on all this type of stuff. So anyway, this is just a checklist what I specifically use. Now, obviously, you can make your own checklist, and like I was saying to you before, the entire list is in the description box. And please use the Excel coupon, because you'll be able to get this for absolutely free. Now, like I was saying to you before, I am going to be doing more videos in terms of assessing. Now, like I was saying to you before, this is mainly just the foundational piece in terms of what I use in terms of finding great investment opportunities. Now, in my Now, in my next couple of videos, I don't really know when, to be honest, but I am going to be putting together some very unconventional ways in terms of finding business data on different types of investments. So obviously, if you want to follow along for that, make sure you subscribe. And yeah, to the 4 people who've made it this far, I hope you're having a lovely day, and I'll see you in the next video. Take care. Bye.